sort of reconcile this recession view over the next year and a half with, again, this resiliency in equities, right? I mean, I feel like we've got a recessionary tailwind. We've got supply constraints on the inflation side, both in terms of the fact that China is still struggling with the pandemic. They're still on a zero COVID policy. They're still shutting down entire provinces and ports at the same time as we're getting 4 to 5 million barrels of oil coming offline sometime in the next few weeks out of Russia. All the other secondary and tertiary impacts of the war. And yet we still have this, U.S. equity markets within 5 or 6% of all-time highs. Like something has to give here.
Yeah, no, absolutely. I mean, you're right there. I mean, the first thing I would say is that Chinese stocks have been trading pretty poorly, and rest of the world stocks in general have generally been trading poorly. Now, in terms of the relationship between stocks and recessions, typically stocks tend to weaken much closer to the point of the recession. So there is a timing issue here where rates markets tend to, just because of the nature of rates market, they tend to be much more forward-looking. And stocks tend to almost like look at the next quarter, so that it matters whether the recession is in the next 3 months or if it's Q1 next year, and if we're saying it's Q1 next year, it's too far away for stocks to really kind of be affected by that. That said, if there is a recession kind of on the horizon, to me, it tells me at the very least stocks should trade sideways. In general, which they kind of in some broad sense they have, especially for the US. What I like to look at is the Russell 2000 rather than the S&P, because I think the Russell reflects the economy much better, because the S&P has the tech companies in there, which are kind of global and they're kind of a tech play and they're not sort of linked to the economy directly. And so
Russell should be even more vulnerable, right? Given that they derive so much more of the revenue from outside the US, and the rest of the world is much more vulnerable to all of the, first of all, you've got the whole dynamic of when the U.S. catches cold, the rest of the world catches the flu, which is typically what happens.
Yeah.
And the fact that all of these other countries are much more impacted by either major commodity price rises and or just proximity to the war and conflict and other types of frictions.
Yeah. I mean, I think it depends on the types of international companies in the US that we're looking at. So I would say, like US manufacturing companies or certain like banks and so on, they would for sure be impacted by slowdown in the rest of the world. For tech companies, it's a bit trickier because, if you look at the behavior of tech companies or the mega tech companies, they sometimes behave cyclically, but sometimes they behave like utilities as well, because they have attractive like dividends or buyback schemes and such. So there's this kind of safe haven dynamic that you have within big tech that makes it a bit more tough to kind of have the read through into the cycle.
I think that's certainly the perception. I mean, I agree. I think big tech is being utilized here by global investors as a safe haven trade.
Yeah.
And I'm personally skeptical.
Yeah, and it's a fair point. It's a fair point, and point well taken, and it would be sort of vulnerable. I mean, I do think that the risk for big tech, for me, would be if we see this, the way big tech isn't responding to higher rates. I think that's interesting. It should reflect, because if the argument is big tech gives you the yields, if interest rates are going up, then suddenly it doesn't give you the yields, and so it should be repriced sort of lower. So I think there's that. I think recently, I think the reason S&P's done well is that US, number one, is outside of the conflict zone, so US gets that benefit. US earnings have been relatively strong as well throughout this whole period, and then also there's this kind of reopening dynamic that also to some extent supports US stocks as well. But I agree. I mean, I think it's really a question of matter of time before we see another, down move in equities. We did see somewhat of a down move in equities, but then the bounce was quite strong recently. I mean, to be honest, I've been surprised about how quickly markets have shrugged off the war risk premium. I was kind of long oil into this all, and suddenly the reversals happened, and I was like stunned how quickly that's happened. And so
could there is probably the cleanest dirty shirt. So,
I
so
think there's that is as well, and I think also there's been a lot of position unwinding, VAR shocks, margin calls. There's all sorts of weird stuff going on in markets right now, and so when that happens, it makes me cautious about reading too much into the price of something, because it could just be some big position unwind, some quarter end rebalancing, some fund has blown up or something, or, you know,
I think that's a really important point to remember through all this, for sure.